Confused about pensions? You're not alone. The Financial Conduct Authority found in their Financial Lives study there were 9.6 million adults, 24% of adults, in early 2020 who were not retired and did not have a pension they were building up. A third of those who did have a defined contribution pension didn't know how much it was worth. In this video, I'm going to tell you all the things that schools should have taught you about pensions. Anyway, I know there is a lot of talk about what if they change the rules. Okay, fine. The truth is they probably will in some way at some point. But pensions still remain one of the best and the most important parts of your ability to save and will likely be the cornerstone of your financial future. So hang on till the end of the video. I'm going to show you why you need to get a handle of this. So firstly, what is a pension? Well, a pension is just a tax-efficient savings account with rules on when you can withdraw. It's designed to look after you in later life. The idea is that you get tax relief going in, benefit from a tax-efficient growth while you're working, and then the tax is applied on the way out. So you've benefited from that multi-decade period where you've had very tax-efficient growth. So don't get lost in all the potential complexities. It is just a savings account with some strings attached. Now, it may also be the case that the pension is under trust, which can keep it outside of your estate for inheritance tax if you die. Now, not absolutely all of them are, so it's always something to check. But there also can be very favourable tax position on the death benefits should the worst happen to you, which means that even if you don't get to enjoy the pension, they can be something that can be left to your family in a very tax efficient way. There really are no other wealth building options which can combine individual tax relief, employer contributions, tax efficient growth, and the tax efficient death benefits. Now, the devil is in the detail depending on your scheme and how this all interacts, which is kind of why I stay in a job. So obviously make sure you get advice specific to you. But for all these reasons, it's likely going to be one of the best ways you can fund your life when you get older, so you need to pay attention. So there are three main pension sources. The state pension, if only someone done a handy video on this. A workplace pension, that's a pension through your workplace, which can be either a defined benefit pension or a defined contribution pension, and I'll explain a bit more about this later. Or a private pension, which are always defined contribution arrangements. So let's go over what types of pension are there. So this could be a long one if we get into specifics, so I'm going to go over the most common. One is defined benefit, and two is defined contribution. So the first up is defined benefit. As the name suggests, the pension has a benefit which is defined or guaranteed. And this is why it relates to a guaranteed income for the rest of your life. How much you will get will really depend on your earnings, the scheme rules, and also how long you work for that employer. They also mostly come with inflation protection, so that the buying power is maintained over time. So you don't have to worry about as much what future inflation will be with these pension payments. And crucially, the risk of providing that income for the rest of your life is taken by the pension scheme, or the fancy way of saying that is the sponsoring employer. There is also normally an additional pension for your spouse, civil partner, or potentially a dependent if you die. This is often, say, 50% of the pension you would have had, or sometimes even 2/3. But the rules can and do vary, so make sure you check them. Now, these schemes have become increasingly expensive to run because the cost of buying the guaranteed income has become more expensive over time. So there aren't as many of them around anymore, although they're still very prominent in the public sector, things like the NHS or police's pension scheme. They really do provide a high level of peace of mind and security because of the guaranteed nature. Now, next is defined contribution. And this is the more common type of pension nowadays, as all that is defined is the contribution. All that is promised is what your employer and you put in. So all that happens is that you contribute, your employer contributes, and you invest the money. And you will have various options at retirement depending on what's best for you at the time. Now, one of the main things to remember is that you're responsible for your investment choices with this type of pension. So the risk of any future income, basically what the pot is going to be, falls on you. You pay in on a regular basis, and if you're a member of a workplace pension scheme, your employer will pay in too. There's a very strong chance you'll be what's called auto-enrolled. Now, the amount you actually get back from this pension will depend entirely on how much has been paid in, your investment performance, and also how you decide to take your money. So it is a bit of an unknown here, and it really depends on investment performance. However, it is also extremely important to check if you have good options for your employer matching your contributions. As this video I did showed, it can nearly double your pension pot, so give it a watch. Okay, tax. Let's chat tax. What you need to be aware of is effective tax rate. This is big, and this is the thing a lot of people forget. The tax you're at now might be very different from when you retire. If you get 40% tax relief on your contributions now, unless you're quite wealthy, you probably won't be paying 40% on the way out. You also don't pay national insurance on pension payments. So the pension grows in a tax-efficient environment, and it's the end where the tax applies I chatted about earlier. Pension income is taxable income. However, both defined contribution and defined benefit arrangements have the option to take some tax-free cash, which is quite a sweetener. There is also potentially very favourable death benefit rules which surround whether you're unfortunate enough to die pre or post age 75. And as I mentioned before, if your pension is written under trust, it's likely to be outside of your estate for inheritance tax. Now, the overall tax position on death benefits does depend on what type of scheme you're in and the rules. So I'm going to park this for another video. But I will stop briefly to say that if you do like videos on pension planning and generally how to organise your finances so you can retire early, well, you're going to be seeing a lot more of this on this channel. So please do consider subscribing. So let's talk about taking the money out, the whole purpose of it all. Now, for most of us, when you reach 55, which is going to rise in 2028 to 57, you can choose to take money from your pension plan. Now, there are some clear distinctions in rules depending on which type of scheme you're in. So if you have a defined benefit pension, you can only choose the guaranteed income for life and some tax-free cash. The income is exactly the same setup as your salary, and it's guaranteed, so it just gets paid monthly to you. But the one thing to factor in here is the scheme will have a normal retirement age. So if you take the pension before that, they're likely to reduce the pension, as all things being equal, someone who's 55 is likely to live a lot longer than someone who's 60. Now, how much this pension or tax-free cash is reduced is by what's called early retirement factors. So it's definitely worth having a look at your scheme to see what those factors are. You also do normally have an additional option to reduce your pension for your defined benefit scheme and take a higher level of tax-free cash. This is called commutation. But for these types of schemes, they're generally a bit simpler as far as retirement options. Now, for defined contribution arrangements, depending on your policy or scheme setup, you'll have one or many of these options. You'll have flexible income, or known as drawdown, and with this option, you take as much or as little money out of the pension as and when you need it. Anything you leave stays invested, so it has the potential to grow. But keep in mind, as that money remains invested, the value could fall as well. You've got a guaranteed income for life. This is where you use your pension savings to buy a guaranteed income, which is also known as annuity. And that gives a set amount of income for each year as long as you live. But with an annuity, there's likely quite a large upfront cost for that guaranteed income. There's also uncrystallised fund lump sum, where the whole financial industry cannot agree how to pronounce it. Some people say UFPLUS, others say UFPUFL and UFPLS. Anyway, it's all the same thing. You take 25% as tax-free income and the rest is taxable. It's not exactly the same as drawdown, but it's extremely similar. And the final option is just leave it invested. And you could just choose to leave your pension plan invested until you're ready to take it, giving it a chance to grow. And like the other situation, you could go up or down depending on how the investment performs. So what is the take home? What do I want you to take from this? I want you to recognize that pensions, while not straightforward, aren't that complicated. They are just tax-efficient savings accounts with some rules attached. So for you and your family, you need to make the most. Or maybe you might be thinking, well, actually property's better than pension. Well, thankfully, I've already discussed these in some of the videos, so give them a watch. Anyway, this has been Principles Personal Finance. I really appreciate you watching. See you next time.